In this lecture, I'm going to explain how to assess a synthetic rating and also what is a synthetic rating, of course, but also how to determine the cost of debt for any company. Now, what is a synthetic rating? You know that many companies have actually been rated by the main agencies such as Fitch, Standard & Poor's, and Moody's. But what if the company that we are analyzing does not have a rating? How do we actually deal with that? Well, very simple. We use a synthetic rating. A synthetic rating is just a way to grade companies based on three main factors. First of all, the industry in which the company is operating. Second factor is going to be the market capitalization. And the third factor is going to be the interest coverage ratio. By using those three factors here, we are going to assess the rating of the company and therefore the spread. The spread is the difference between the risk-free asset and how much we have to pay more over the risk-free asset to borrow money from the markets. Because remember, the risk-free asset is just that asset that we assume is not going to fail. One example of risk-free asset, of course, is the US Treasury bond of 10 years. Therefore, we call it risk-free rate. It means that you're going to get your capital back for sure. You are sure that your capital is going to be safe. Now, having said that, how are we going to do so? We are going to assess this synthetic rating and then eventually the cost of debt for the company that we are analyzing in 3 steps by following those 3 boxes here. In the first box, we are going to assess the market capitalization. In the second one, we are going to assess our interest coverage ratio. And in the third one, we are going to complete everything by assessing the rating, the spread, and the risk-free rate. That's how we're going to get our cost of debt. Now, what I did here, I already took some data. I took this data from Damodar, which is by far one, if not the top professor and practitioner in corporate finance. He is professor at New York University. Therefore, we can rely on this data here. What we are saying in this table is that if the company that we are analyzing is operating in the non-financial service industry and its market capitalization is less than 5 billion, then if the company has an interest coverage ratio that goes from 10 up to 12.5, then automatically the rating is going to be AAA, and therefore the spread for this company is going to be 0.75%. It means that, for example, if we have a risk-free rate of 1%, the company is going to pay 1.75%. The lower is going to be the rating, the higher the risk for the actually to lend this money to this company, and therefore we want to ask a higher interest rate, and therefore you see that the spread here goes up from 0.75% up to 20%, which is the company that defaulted. In this other table here, instead, we have companies which have a market capitalization of over 5 billion. Usually the interest coverage ratio, as you can see, compared to smaller companies, is going to be a little bit lower, but although lower, is going to be more or less the same rating. So as you can see, while for the smaller organization, we have an interest coverage ratio of 10 to 12.5 that gives a rating of AAA. For the big organization instead, for the big company, an interest coverage ratio that goes from 10 down to 8.5 is going to give a rating of AAA and therefore a spread of 0.75%. The assumptions that we are going to use are here. As you can see, the company that we are analyzing is operating in the US, and therefore the market capitalization is 4 billions. The earning before interest and taxes is 5 millions, and the interest expense is 2 millions. Now, eventually we're going to have to find also our risk-free rate to assess the cost of debt. Let's take one step at a time. In the first box here, we want to assess whether the company is over or less 5 billion of capitalization. And if we look at the information that we have here, we know that the company is 4 billion in market cap. Therefore, we input not here because the company is less than 5 billion, and therefore we input not just to know that the company is less than 5 billion. Now, another thing that we want to know, we want to compute in the second box the interest coverage ratio, and we do so by taking our EBIT, our earnings before interest and taxes, that is actually here, 5, and then we want to get our interest expense, and we want to input it there, and our interest expense is here. And that's it. As you can see here, we got our interest coverage ratio, which is 2.5. Now we want to compute, we want to actually fill the last box, the third box. Since we know that the company has a market capitalization of less than 5 billion and an interest coverage of 2.5, and this company is operating outside the financial industry, let's give the rating to this company. Which table are we going to use in this case? Well, since the market capitalization is less than 5 billion, we're going to use this table here. And since we know that the interest coverage ratio is 2.5, since you can see it from here, it's 2.5, we can actually see here that for an interest coverage ratio of 2.5, we're going to have this rating, and therefore we want to recall this cell here. So let's go on 2.5, we recall the cell of the rating here. That's it. And then we know that for the companies which have this kind of rating, so B1 or B+, they're going to have a spread of 5.50%. Now, to get our cost of debt, we are missing the last step, that is our risk-free rate, because we know that the cost of debt is given by the risk-free rate, and we add the spread for the company that we are analyzing, and that's how we get our cost of debt. How do we get this risk-free rate? Well, we can go on Bloomberg.com, and if you open this link up, I already did it for you. So I found the risk-free rate at 1.82%. But if you go on this link here and you find the 10-year Treasury bill, you're going to take this rate here, and this is going to be your risk-free rate. And therefore, if we go in our spreadsheet here and we input this cell, which is the risk-free rate, we recall the cell here, we finally have our cost of debt, which is 7.32%. This is given by the risk-free rate plus the spread, so the additional interest that the company has to pay to borrow money from the markets. And that's how we get our cost of debt, assuming though that the company has no capital leases.